If you're looking up this video, then you probably don't trust your bank, do you? We're gonna dive right in and just learn from history. Because by the end of this video, you will know if banks are actually a safe place to keep large sums of money, and if they aren't, where should your money go? All right, so let's just dive in. We're gonna go into the history here, right? Because the real fear of banks for people happened during the Great Depression. Now, there have been multiple recessions and depressions, even through the 1800s and whatnot. It's no surprise that banks have failed. But the one that's fresh more in this generation's mind, and also, although most of these people have been dying off, has been the Great Depression. During the Great Depression, 50%, one half of banks failed. Now, why did they fail? That's the real thing we gotta ask ourselves. During that time, the Roaring '20s was leading up to that 1929 market crash that eventually led to the Great Depression. The Roaring '20s were awesome. Everybody was high on euphoria because everything was great. Everything was awesome, just like the Lego movie says, right? Nobody could lose, and that's what happens. When there's the pride, there's the fall. Also what happens is that banks would lend out money, really, without a lot of care. They would lend out money to people, and those people would take that money and throw it into the stock market. They would gamble their money into there thinking, hey, the market's gonna go up. Let's just keep making money. This is brainless. Well, they did that, and when the market started crashing, people started panicking because they realized they had a loan. And of course, they tried to make a run on the money to get the money out. Banks didn't have a lot of that money because they're saying, well, we need the money back. This is why during the Great Depression, they even called mortgage notes due. They said, hey, we need to call loans due and get it back. Well, they called those loans due and then money was lost in the market. People couldn't pay it back. They're out on the street. Everybody's losing their jobs. Things are going crazy. Money gets tight. Well, as a result, they learned some big, big lessons. Banks realized they could not be that careless. So the government decided to put some protections in place. They created what was called the FDIC. The FDIC really is supposed to make you feel warm and fuzzy. They say, hey, your money's in here. You'll even see like little things at your bank will say FDIC insured. They'll put up the little signs when you go to that desk. If you go up to the desk, you might even see it in the window when you drive through in the window, right? FDIC insured, all over their website. What they're saying is the FDIC stepped in saying, we need to make sure there's a reserve just in case banks fail. We got to protect people's money. Understand though, they only protect up to $250,000, $250,000 in your account. Also, and here's the other thing. This is the most, I believe, the scariest part of this, right? Here's the scariest part. The FDIC, if you look up the numbers, they only have roughly, and I'm being generous here, about 3% of that money in reserves. That's in the total bank balances. So if 10% of banks start failing, they only have 3%, they're already in trouble. They're already bankrupt. You're not gonna get your money overnight. You're gonna have to probably wait some time, most likely for the feds and for the government to try to figure out and panic and print more money so they can give you this diluted dollars that now it will be inflating like crazy, right? That's what they'll probably have to do if we ever have bank failures again. But there's been other things put in place besides FDIC. They also won't allow you to borrow money to put in the stock market. When I was a financial advisor, I remember I would have people sign an initial little forms saying, hey, here's some things you need to understand before you buy this mutual fund. One of those things you signed off on says you did not borrow money from the bank to invest in the stock market. They don't want a repeat of the Great Depression and something like that to happen. Doesn't stop people from doing it necessarily, but again, they make that disclaimer saying you better not be borrowing money to put it into the stock market, or we're gonna have some words on a piece of paper that you just signed, apparently. So you gotta be careful of that. So the banks have tried to do things to protect themselves, but it doesn't mean it's foolproof. And if you have a lot of money, especially if you have over $250,000, well, what do? Okay, here's a few strategies you could do. One is you can start splitting up your money between different bank accounts or different banks. You could say, okay, I'm gonna keep up to $250,000 in this bank account, go to the next bank, keep $250,000 there, next bank, $250,000 there, next bank, $250,000 there, assuming you have $1 million to distribute. Now, if you have $1 million, you're just sitting in the bank accounts like that, you're probably wondering if you're gonna make any money on it at all in the first place. You might put into CDs or whatnot just to kind of at least get a little bit of interest, even if it's not much, but earn something on your money if it's gonna just sit there in the meantime. But you can do that, but understand that again, FDIC doesn't have all the reserves to cover all the bank balances. Remember, the Great Depression, 50% of banks went out of business. If that were to repeat again, that would be a problem. If you also recall the last recession, banks were also having a big issue then too, weren't they? Especially the big 5 banks. We had to have the government bail them out, give them money to keep them from going under. Why? Because once again, the banks loaned out too much money. And in fact, Congress even approved for some of those big 5 banks to loan out up to 40 times the amount of money that they actually had in reserves. So if let's just say they had $1 billion in reserves, we know they have more than that, but let's just say it was $1 billion, they were allowed to loan out to people $40 billion. Well, if that's going to high-risk mortgage notes and other things too, heck, even if you lost 10% of that, that's $4 billion. That's 4 times the amount of money they had. So yes, banks got in trouble once again, but the feds tried to bail them out. Kind of avoided a big catastrophe there. Some people argue that was good or bad. That's the thing. But for you, it is good because at least you didn't lose your money. But it was very scary. And in fact, there were many smaller banks that did go out of business during that period of time. So that could have affected your money. Luckily, the FDIC was okay during that period of time because not all the banks were going out of business. It was just a small minority. But be careful. So you could split up between different bank accounts, but it doesn't mean that all 4 of those accounts, if you have $1 million, will be protected. So what's another option? One option that I prefer to use, although I do still use banks, and I even use online savings accounts to make a little bit more money, I use infinite banking. Infinite banking is where I use life insurance policies, specifically whole life insurance that has lower cost, higher returns. I don't like the traditional whole life. That's all the high cost, high fee type stuff that pays the agents lots of money, but not me. That's a bunch of crap. I like lowest cost possible so I have the most cash built up in there. Now I do that for a few reasons. If you have a lot of money, this is important because in most states, you are 100% protected from lawsuits and creditors. So I can store my money in here, keep it protected from lawsuits and creditors, where a normal savings account is not protected from lawsuits and creditors. You have somebody that sues you and wins, or there's a lien put against you, they can tap into your accounts, pull the money out, it's gone. They can't do that with life insurance, even if you have millions of dollars stored in there. That's number one. Number two, because I'm tired of making 0.nothing% in my bank account. That's why. I like the fact I can make at least 4, 5+% tax-free returns in my infinite banking policy. Understand that at my bank, I make 0.05%. I get taxed on 0.05%. Means I really make more like 0.03%. That sucks, right? That's almost nothing. Where in my infinite banking policy, I can make much more. So for example, my wife said, Chris, I wanna make sure we have at least $250,000 secure. Like we don't spend it, we don't invest it. It's just for emergencies or whatever comes up in life. I said, great. Well, I could store it in the bank and be FDIC insured, but I'm gonna make 0.nothing% on that money. And then I pay taxes on that little bit of money I make. Or, like I told her, I said, we can keep a little bit of money in the bank in case we need money that day, but let's keep the bulk of it, the lion's share of it, inside our infinite banking policy. We did that, so we got $200,000 earmarked inside of our life insurance. We actually have a little bit more because we're actually saving for some bigger opportunities coming up with these downturns in the future. But $200,000 earmarked that we're not gonna touch. Well, guess what? That $200,000, even if it makes 5%, that's making me $10,000 a year tax-free interest versus $200,000 making, 0.05%. It's making me like, $10 a year, right? Or whatever it'd make it, $100 a year, I guess it would be. That's nothing, right? That's just piddly. It's crap. I want to make more money than that. And that's why I use my infinite banking policy. Great place to store cash. And even better, like we have said in other videos, we can double dip our returns too. For the other money I can use to invest, I can get that money working for me in 2 places at the same time, where I make money inside my infinite banking policy and I can get a line of credit against it to go and invest, making returns where I don't just make like 10% returns on a real estate deal. I make maybe 11, 12 or more % returns because I use my infinite banking policy instead. So lots of great ways to do it. Again, learn from the depression, learn from the recession, learn that banks, although they could be safe, they may not be. And so you gotta understand that storing your money there's still some risk. There's risk in everything. But the nice thing is with insurance companies, they buy reinsurance on their money, don't they? They actually have to buy reinsurance from bigger insurance companies that insure them in case of loss. So they have their own like FDIC, but if you go from history, from the Great Depression, guess what? Only 4 life insurance companies went out of business while half of banks went out of business. Why? Because life insurance companies can't over leverage like banks can. They can't go and loan out more money than they have. They can only use the money in their possession to use. That's why they don't go out of business. It's so rare to see that happen. And even if they do, we got reinsurance companies to back them up. So in my opinion, life insurance is actually safer than using a savings account. But you can use whatever you want, right? Again, I learned from history. I said banks are okay for short-term little bits of money, but I like to keep the lion's share of my money inside my infinite banking policy. And there's lots of things you can learn about that on our YouTube channel right here. Guys, if you thought this was interesting, check out this next video, how to achieve financial independence and retire early.